Alfred, thank you so much for joining us. To start us off, can you tell us the top 3 themes for low duration income from your perspective?
Okay, so first, the low duration income strategy is a strategy where we're trying to generate an attractive level of income while trying to protect against the downside. In contrast to the income strategy, the main differences are that we're trying to have lower interest rate risk and to have lower credit risk, and overall, hopefully have less volatility as well. Now, in today's environment, we think that the volatility will continue, but the starting point in yields is very elevated today. So that's positive for return generation if nothing happens. Greater potential for capital appreciation if you do have an optimistic environment, and better downside protection if you do have a more challenging economic environment. And the trade theme that we find most compelling today in the low duration income strategy is to take advantage of the deleveraging of the banks. What we're seeing today is that we have this unusual phenomenon where we have the ability to move up in credit quality and pick up spread. So that's the top theme that we have today.
So, hearing that, some investors may think it is simply the flagship income strategy with a lower duration profile. Is that how you and the team manage the strategy?
I'd say that in general, we're using the same macroeconomic themes. So the objective is to try to have less volatility in the low duration income strategy than income strategy. So it's not just an income strategy with less interest rate risk. It's also in general trying to have less credit risk and hopefully then in combination have less volatility overall.
You mentioned that low duration income invests across global bond sectors. How do you feel that differs from a single sector approach in the short-term category?
So we think it's very beneficial to have both flexibility to take advantage of the global opportunity set, but also have the resources of PIMCO to capitalize on the global opportunity set. What we've seen in financial markets is that there's volatility from time to time, and some asset classes in some periods are very attractively priced, other periods, other asset classes are more attractively priced. So having the flexibility to rotate between various sectors of the global fixed income universe, we think is beneficial. But it's also important to have the resources of PIMCO to capitalize on this flexibility. If you just have flexibility but don't have the resources to capitalize on them, it's actually not going to be particularly beneficial for investors. So with respect to the low duration income strategy, having the flexibility but the resources to capitalize them, that's something that we think has worked very well over the years for investors.
So what specifically about today's environment makes low duration income strategy particularly attractive? And how should investors think about this in light of interest rate volatility and monetary policy uncertainty?
So I'd say the investment theme that we find most compelling today is to take advantage of the deleveraging of the banks. What has occurred is that the banks today are trying to de-risk their balance sheets. The banks lost hundreds of billions of dollars in 2022 when rates sold off dramatically. And today, the banks are trying to hoard capital. So investments that the banks typically have found attractive to invest in, such as agency mortgage-backed securities or other higher quality asset-backed securities, today the banks are not investing in those asset classes. And what we've seen today is that you're actually getting a wider spread if you invest in agency mortgage-backed securities, which are bonds that are backed by residential loans that have a guarantee for the government or an agency of the government, than if you invest in investment-grade corporate bonds, which might be, say, triple B rated. So we like the idea of moving up in credit quality, but also picking up spread at the same time. That's something that's unusual in the fixed income universe. So that's the main theme that we find attractive to invest in. With respect to interest rate risk, we think that today the level of rates is quite elevated. We think over time, interest rates are going to be coming down. So that's another area that can supplement returns. And then with respect to credit exposures, we think that having a tactical approach with respect to credit is something that's warranted in today's marketplace. We think there'll be lots of volatility, and having ability to deploy capital and take advantage of this volatility is something we think that's something that's very compelling for the low duration income strategy.